Hey everyone, welcome back to Corporate Decoder. Today STRW just filed an 8K announcing a material definitive agreement, and I am seeing a significant shift in their financing strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company has secured a substantial new credit facility, which could power their future growth, but also comes with its own set of considerations. Alright, let's dive into this 8K filing from Fields REIT. This report tells us about a pretty big financial move they've just made. It is all about how they're planning to fund their operations and potentially grow the business. The headline here is the closing of their corporate credit facility, or CCF, which gives them access to up to $300 million. This is a pretty significant amount of money for a company like Fields REIT. This facility was officially closed on the 18th of June 2026, and they announced it in this filing. So who is actually getting this money and what are the details? Fields Realty LP, which is a part of Fields REIT, has entered into two main agreements. First, there is a term loan and security agreement. Think of this as a loan for a specific amount that they plan to pay back over a set period, and it is backed by some of their assets. They also signed a related term loan note, which is essentially the document that lays out the specific terms of that loan. With this term loan part of the deal, Fields Realty LP has already borrowed $100 million. Now let's talk about the price of this money. The interest rate is tied to something called the 1-month CME term, SOFR rate, plus an additional 275 basis points. For us regular folks, that just means it is based on a benchmark interest rate plus a bit extra. But here is the kicker, it will never be lower than 5.50%. This way, the bank is protected if interest rates drop too low, and the company knows it won't pay less than a certain amount. This loan is set to mature on the 18th of June 2029. That gives them 3 years to pay it back. Now, there are also two 1-year extension options, which means they might be able to push the repayment date back if needed, but that will likely come with specific conditions. To secure this $100 million loan, Fields Realty LP is putting up a portion of its assets as collateral. This means if they can't repay the loan, the lender has the right to take those specific assets. On top of that, Fields REIT itself, as the general partner, is guaranteeing this loan. What this means is that if the REIT's subsidiary can't pay, the parent company is on the hook. Certain real estate subsidiaries are also guaranteeing it, which spreads the risk a bit. The second part of this big financing deal is a revolving credit facility with a total of $200 million available. A revolving credit facility is different from a term loan. It is more like a flexible credit card for businesses. They can borrow money, pay it back, and then borrow it again as needed, up to that $200 million limit. It is great for managing day-to-day operational needs and unexpected expenses. Just like the term loan, the interest rate for this revolving credit facility is also tied to the 1-month CME term. SOFR rate plus 275 basis points with a floor of 5.50%. This means the cost of borrowing fluctuates with market rates, but there is a guaranteed minimum cost. This facility also matures on the 18th of June 2029 with the same 21-year extension options. Similar to the term loan, this revolving credit facility is also secured by a portion of SFRLP's assets. And again, Fields REIT, along with some of its real estate subsidiaries, are providing guarantees for this facility. So why are they doing all of this? The money from this entire $300 million credit facility is earmarked for a few key things. First, they plan to refinance some existing bank debt. This often means they're getting better terms or consolidating their loans. Second, it is to support acquisition growth. This tells us they are looking to buy more properties or businesses. And finally, the funds will be used for working capital, which is the money needed for day-to-day operations and for general corporate purposes. Now, about the exhibits. The filing lists the term loan and security agreement, the term loan note, the revolving loan and security agreement, and the revolving loan note. These are the core legal documents that detail everything we just discussed. It is important to note that these full documents are not being filed with this initial report. The company states they will file these exhibits as an amendment by the 25th of June. This is pretty standard, giving them time to finalize and submit all the necessary paperwork. And finally, the signature block, dated the 22nd of June 2026, signed by Moish Gubin, the Chief Executive Officer and Chairman of Fields REIT Inc. This confirms the company's official acknowledgement and filing of this report. Now, Looking at this filing beyond the technical details, what does it really mean for Strawberry Fields REIT? Securing a $300 million credit facility is a significant move for a company with a market cap around $182 million. This is a massive injection of potential capital. It strongly signals their ambition for growth, particularly through acquisitions. As mentioned in the filing, this aligns with their business model as a REIT, which often relies on expanding their property portfolio. The fact that they are refinancing existing debt suggests they might be optimizing their cost of capital, potentially lowering their interest expenses if the new terms are favorable. The dual structure of a term loan and a revolving credit facility provides both long-term financing for planned investments and short-term flexibility for operational needs. However, we also need to consider the risks. The interest rate tied to SOFR plus a spread means their borrowing costs will increase if benchmark rates rise. While there is a floor of 5.50%, any further increase in SOFR above that will directly impact their interest payments. The guarantees from the parent company and subsidiaries mean that if the operating entities struggle to repay, the parent company's financial health could be directly affected. This type of large secured financing also places a lien on a portion of their assets, which limits their flexibility in using those specific assets for other purposes. Compared to other healthcare REITs, this move could position Strawberry Fields REIT more aggressively for growth. Companies like this often use debt to acquire more facilities, which can lead to increased rental income and potentially higher dividends for shareholders. We see from the research context that Strawberry Fields REIT is in the healthcare facilities REIT sector. Major institutional holders like BlackRock and Vanguard suggest a level of investor confidence. The current price is trading near its 52-week high, indicating that the market might already be anticipating positive developments. What I am actually looking for is how they deploy this capital. Will the acquisitions be accretive, meaning they add more value than they cost? And will their revenues grow enough to comfortably service this new debt load? The risk I am watching is the potential for over-leveraging if the acquisition strategy doesn't pan out as planned. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.